And can you confirm, John, that you're seeing my screen and all is good?
I see. Thanks for joining us. Is that it?
That's the one. Fantastic.
And I can see it.
We are on the move and all good.
I guess we're taking the training wheels off the bicycle here. We don't have Asher holding your hand.
Yeah, exactly. After last week with the data roaming running out. So let's get straight on today. Thank you very much, everyone, for joining us once again. And today our special topic is debt versus equity regarding property crowdfunding. And as you can see there, we've been joined by Mr. Tony Ulner. He's put forward a photograph, which I don't think was taken yesterday. But certainly he seems to be having fun. Don't know if he's out with his friends or doing something recreation, but we'll get into that maybe later on. Tony, you can give us the context of the photograph.
Yeah, they've been crudely removed from the photo.
Very good. Okay, so market update. So obviously these slides have to be pre-approved. So we're well aware that it was the budget yesterday. So we're going to wait till next week really to get into the details of the budget. But certainly there were some very interesting things that happened. But in terms of headlines that there were as of yesterday, there's obviously this plan to extend the stagger stamp duty, the holiday for that. And yeah, I'll be interested just to see how these things all play out over the next couple of weeks. I don't know, John, if you had a chance to look at the budget, if you have any observations, or if you managed to do that.
I mean, I looked at some of the high points: the corporation tax, the stamp duty stagger, support through September for furlough. We're definitely in difficult times when it comes to transitioning from COVID, the original impact, now with vaccinations. How are we going to come out of this? What does that mean for the economy? You got to pay all the bills back. 200-300 billion of extra borrowings got to show up somewhere. So, but next week, right? Next week we're going to do a deep dive.
Yeah, I think it'd be better next week because sometimes it takes a couple of days, I think, to really assess everything. You can kind of knee jerk it on the headlines, but then people begin to think the what if. Well, if that happens, then how does it affect this? So I think next week's a good time to spend maybe 5 minutes looking at it.
I mean, the big one for property people that wasn't mentioned, or at least I didn't see, was capital gains tax. So, that might force some large landlords to rethink, but that doesn't appear to be in the budget. So we'll see.
Yeah, we'll see the work inside of that. So any comments, Tony, on the budget?
No, I agree with what you said, actually, and inheritance tax as well.
Yes, that'll be another good one to look at. So another thing that I think's relevant in terms of market overview is this mortgage guarantee scheme. This I think is very, very positive. That literally for deposits of 5%, people can start to get on the property ladder. So again, it'll be interesting how this plays out, but certainly a very positive move to stimulate, sales and people buying and selling houses. So I don't know if either of you have any major comments to make on that, or come in the US, John, to do stuff like this in the US to try and stimulate growth, or?
Well, I wouldn't say stimulate growth. So the FHA has had a 3% program for about 50 years. And it is a first-time buyer type scheme in the sense it's not really available above a certain level. And it's meant to be a way of getting on. There is an insurance element to it where the UK, I'm not quite sure how they're going to handle the extra risk. At the same time, I want people to understand that just because you're born doesn't mean you should own a house. So this isn't meant for everybody to buy a house. It's a way for people that want to make that transition, that commitment, and the taxpayers bear the risk. So we have to be a bit prudent about how this gets rolled out. Not that we can control it, but.
Yeah, no, very much so. Okay, we'll see how that plays out. Okay, so last week we did our review in terms of really getting into feedback from the listeners and from the audience, and I want to thank everyone for that. It was really useful for us. So we have been having various conversations, and you could probably summarize it by you spoke, we listened, and next week we're gonna make some comments and some changes to the format and the presentation, So you'll see that being implemented over the next couple of weeks. But thank you for that. And again, today, as we get into the discussion, or if you have any comments to make or observations, then please use the Q&A. We always encourage and want as much feedback as possible. And I know that many people on this on a regular basis. You've put it in your diary now to join us. Well, you're probably professionals in your own right, and we're really keen to hear your input and hear from you on this. So, quick update on last Friday's masterclass event. Absolutely delighted with how this went. Really, really, really happy. We had over 30 potential fundraisers who attended the course. People paid from $9.97 our early bird right up to $49.77 for our sort of late purchasers. And over 30 fundraisers joined us. It was 3.5 hours. It was sort of fast paced. We had 5 different speakers. The feedback has been excellent on this from the fundraisers. And you can actually purchase the recording. So if you're interested in that, contact us and you can purchase the recording of that for $15.97. So John, you're one of the speakers. How did you sort of find the event in terms of the quality of fundraisers that attended and just your overall take on it?
As a speaker, you don't get to interact with the room in this COVID world quite the way you would if it was a physical event. So I'll leave comment on that. But I thought there was a good flow to it. We definitely benefited from having Angus there when it comes to his perspective as a full-time landlord, but past enforcement officer at the FCA. Mm-hmm. So he gave us some perspective about what you can and can't do. I think there is a direction of travel with the FCA towards clamping down on speculative investments, and definitely what they think that is real estate investing when it comes to buying and adding value. So Angus framed it. Karen and Antoine covered, how to communicate or network with property investors. So that went well. I really was impressed with Aisha's topic about how the psychology of investors, that what people say versus what they do, there's quite a bit of a difference sometimes. And then we heard what I thought was the money shot, which is how to use social media to get the word out.
Mm-hmm. Yeah, no, very much as you say, it was a great array of speakers, and Aisha's sort of peeling back the mindset of investors. Obviously, she's got a lot of wealth of knowledge and experience in that arena, and definitely I think fundraisers, had never really thought sort of in the shoes of the investor before, and that's an important mindset to have. It's their project. They're emotionally attached to it. They maybe invested their own money in it. And they think everyone should have the same excitement about the project as they have, but investors come at it wanting to see the detail. Show us the financials, show us your DD, show us that you know what you're doing, show us your track record. I want to build trust with you. I want to get to know you a bit before I decide to invest. And that came across very well, I think, in Aisha's presentation, which is brilliant. So the good news is, John, that our next masterclass that we're going to plan for the end of April is actually going to be on that very topic. It's going to be on investor, on the whole investor journey and why investors should look at property crowdfunding as a means of building their portfolio. And I think that's going to be a fascinating workshop. And I think even given COVID, the options for an investor, if an investor has some money and they're looking at all their options, and of course we do not give financial advice. This is just a generic comment. But the idea of going out and having to find 4 or 5 different deals as an individual and visit sites and try and do DD and meet the developer, on your own, versus coming to a platform and deploying capital in multiple deals across multiple market sectors in property, through a regulated platform, has got to have a big attraction for actually building a whole portfolio. And I know, John, you're passionate about passive investors using this mechanism to build wealth.
Well, sort of my own case. So I'm a bit lazy. I don't want to have to be running around right now. In this COVID period, there's people in the household that I need to sort of help protect. So being able to have the deals brought to me with the information collected, and then I can look at it and decide how to invest across a few deals makes a whole lot of sense.
Yeah, absolutely. Okay, so let's get on with today's topic. Tony's waiting patiently, and I see Asher with his sense of humor has chosen a slide that Well, it's a little bit of conflict there. There's a little bit there's going to be a contest between equity versus debt. So Tony, I think he set this up in a very a very telling way. So what is better, equity versus debt? And obviously we're talking in the realms of crowdfunding. But before we get into it, and then John's going to actually just talk about the capital stack. But Tony, thank you for joining us. I know you're a sort of property crowdfunding consultant currently. You've had various sort of high-level executive roles. So listen, talk us through your who you are, your background, and some of the things you've done within the world of peer-to-peer.
Yeah, initially I hail from the banking industry, and I made the transition to crowdfunding several years ago, starting at one of the big four, which is Rate Setter, helping them with their processes and setting up their innovative finance ISA, and also helped out PropLend as well, and Capita, as you say, on this background here, helped set up Easy Money from scratch. Again, applying for the innovative finance ISA and getting all the procedures and processes in place. And then more recently, just involved in a startup again, which is Alpha Seed and Hybrid.
Okay, so you've known what it is to be, right in the sort of the operation side of these businesses. You've set them up, you've taken them through regulation, you've managed the staff, you've obviously managed the funds, particularly on the peer-to-peer side. So
on the compliance side as well.
Yeah. So I mean, you've been at the cold face of actually running property crowdfunding platforms.
Yeah, right across from compliance as well, mainly on the, of course, on the peer-to-peer side.
Yeah. So I was wondering, are all those, if there are books or videos or CDs behind you, are they all your research on debt loan-based peer-to-peer platforms? Are they?
No, I mean, this is, I suppose this is my office, but it's also where I store all the CDs as well. That's my other huge hobby, I suppose you could say that.
Right.
If you think that's a lot, then goes over to that side as well.
Right. Very good. Oh, maybe that's equity on one side and peer-to-peer research on the other, possibly. I don't know. Very good. Okay. So let me switch over to John just to really set the scene. So, because I think it's very, very important that people understand when we talk about debt and equity, really where that fits in terms of the capital stack. So John, if you want to just take us through this sort of in a minute or two. And I think I'll say up front, obviously they're not mutually exclusive. People can do debt and equity, but for the purposes of today, we're going to kind of have a debate of what's better for investors. So John, I'll let you sort of set the scene for us, and then you can sort of moderate as Tony and I go at it.
Okay. So I think it's fair to say that for many real estate investors, you're going to use debt and you're going to use equity, and they will be combined in one project. There'll be some projects, planning uplift, where you don't even own the property. You're not able to secure a loan, so you probably won't be using debt. There may be some religious reasons why you don't want to use debt. Those are all perfectly fine. The key, though, is the bulk of the market, the biggest part of the market, will show transactions that have some debt component and some equity component. And the equity, you could say, is the deposit, it's the fees, it's everything else that you have to put in that the lender won't cover. Now, it's my personal opinion, debt is the easy part compared to the equity, that you classically run out of equity long before you run out of debt. If you have a reasonable deal, good deal, great deal, and you have enough cash, then there'll be a lender. They may not like it exactly, so they'll lower the LTV or they'll raise the interest rate or something else. But fundamentally, the bottom part, the red, those layers are the part that I think you can find the most easy if you have enough of that green bit, that stuff at the top. And what you'll find, funny enough, most peer-to-peer platforms that do the red, they can't do the equity. That's part of the license. They don't want to see crowdfunding for the equity for some reason, but they're happy to talk about crowdfunding for the debt. Now, if you can arrange the debt, which I'm saying there are many great lenders, peer-to-peer platforms, but also high street banks, challenger banks, specialist bridge lenders, that equity then becomes the linchpin that the whole deal will pivot on. So over to you two.
Mhm. Yeah, I like the way you talked about equity being the linchpin of the whole deal. I think that's a great first blow for equity. But no, Tony, I'll let you go first then. In terms of debt, stroke peer-to-peer and loan, we kind of lump those all together as opposed to equity. So just to explain really what is the structure of debt peer-to-peer? What's the sort of the mechanism of the money being deployed into a deal?
Well, essentially with peer-to-peer, I think the main difference between equity is usually you won't have much of a choice in what you're actually investing in. So if you think of it essentially as a loan and you're getting the interest paid back each month, usually a short-term loan between sort of 12 and 24 months. Although on the debt side, there is more potential to be diversified across several different loans. So you may not actually see what your money's going towards as an investor, but you've got that spread of investment. So even if one portion of your portfolio fails, it's less of a hit on your investment because you're probably diversified across several other loans. Of course, the more you're diversified, the more chance there is that you're going to get a loan that defaults. But if you find a platform that's got good mitigation in place, you can be well prepared for that.
Mm-hmm. Okay, so it's loan. So peer-to-peer really gives you a loan that's been made to the project, and the investors getting their their fixed return. And on the equity side, then it's not a loan. What's happening on the equity side is that the investor is buying a share in the SPV that owns the asset. So it's clearly completely different than loaning money, and that really leads on, I suppose, to point two. So it's a loan versus a share of the business. On the equity side, then there's not security in the sense that there's no first, second charge or anything like that, but Tony, on the debt and peer-to-peer side, obviously security is a big factor and a big plus, I suppose.
Yeah, the platform will want to take collateral and usually have a first, sometimes a second charge on a property, usually about just up to 70% LTV. And in the event that the loan does default, they can obviously sell that property to get the money back. They can have other mitigation in place as well. Some companies have provision funds, although the provision fund is obviously run entirely by the platform. So the investor has no say over what proportion of the, whether they do get anything from the provision fund. It's just an added layer of mitigation. But ultimately, there is a security attached. Otherwise, they don't get the loan, just like any loan.
Okay. Now, I think that there's a slight twist to this sometimes. So some people have in their mind, I think, Tony, that sort of, well, peer-to-peer, it's safer, it's safe, there's security, there's first charge, second charge, there's maybe PG, there's maybe debentures against the company, et cetera, et cetera, et cetera. And then when they look at equity, they go, but there's no security, which is true. And there's definitely an element that the security is different. I argue sometimes, though, and I don't know what John thinks of this, and I'm guessing he might side more with you than me in this, but from a security point of view, to me, the share is the security. So where a peer-to-peer loan, if it defaults, if it goes horribly wrong, which is the only time the security is important, if a project fails or a platform fails for that matter, then the chances are it's going to take years for the investor to get their money back, if ever. Whereas on the equity side, where there isn't charges and security in that sense, they actually own a share of the SPV that owns an asset. So even if the development doesn't go well and it doesn't meet its financial targets in terms of ROI, they're still a shareholder in an asset that owns land, which to me has to have some intrinsic value. So I don't think the gap is as big as people make out between equity and debt when it comes to security. I don't know if John wants to jump in on that.
Well, two things. One is it's been common, or well, maybe I shouldn't say common. It's happened that even when a loan defaults and the eventual loan is paid back, some of the deals have paid back at less than the agreed amount.
Yeah.
So there's been a forbearance, which means that you delay going after them. And then there's been some sort of haircut, which means they're cutting your return and things. So just because you have a charge doesn't mean it's always going to play out well. It's classically true that it doesn't for big commercial banks. So there is security. It is a first charge. They are first in line. The equity is closer to a joint venture. So when you do a property deal, when you invest in a property deal, you're not first in line if you're the joint venture partner or if you're the person in charge of the project. The lender is the person or party or entity in front of you. So there is a difference there. And that's why your returns are lower on peer-to-peer compared to what you're likely to be offered, but not necessarily receive on the equity side. So do you want to do a loan? Do you want to be a joint venture partner is really the assumption here. And understand on the equity side, you probably have no voting rights, you have no control. You probably don't even have the competence to run the project. So you are slightly in the hands of the developer, the person raising the money. Therefore, there's that risk. But that same person is the person if you are on the lending side. So you have to do your homework, but you need to understand what you're getting into and understand what it could look like if it doesn't go well.
You're also in the hands of the platform with regards to how they chase late payments. And sometimes it can actually work to your advantage to have a late payment because the interest will increase.
Yeah, that's the case where I've seen the platform chose not to do any of that.
Yeah.
And my impression was they were trying to keep the borrower sweet to the detriment of the investors who funded the loan. So the borrower would come back to the platform. And I thought that was a bit of a conflict of interest.
Yeah.
Mm-hmm. Yeah, that's actually an interesting point in terms of on the equity side, once the deal's done effectively, while the platform is still involved in monitoring and in investor relations, really the investors are now a shareholder in the SPV. And to that extent, it's between the investors and the SPV, what happens beyond that. Whereas on the debt side, you've always got this platform in the middle, if you like, that is responsible for the loan effectively and the administration of the loan.
Well, not even effectively. Legally, the loan belongs to a trustee. It doesn't belong to the actual individual investors. They are a secondary interest in that instrument.
Good point.
And of course, on the P2P side, the investors will never meet the fundraiser or have any interaction with them usually.
That's a good point.
Go ahead, David.
Drop down to the education side of things. That's probably the good point to mention that. On the education side, equity, we make a lot of noise about the fact that we can allow the investors who become shareholders to have easy access to the fundraiser, sort of follow the journey from the backseat of the vehicle, if you like, and have an education opportunity, which, if you just said, Tony, in debt peer-to-peer, that just doesn't happen.
No. It's like John said as well, if you've got criteria that and you're quite moralistic in a sense about what you want to invest in, you've got no control. You don't know what you're invested in with peer-to-peer sometimes. So you could be you're relying entirely that the platform's done their due diligence on the borrower.
Okay. So worst case scenario then. So what is the worst case scenario, Tony, on the debt peer-to-peer? What's the kind of the worst example you've come across of it going horribly wrong, and how did that look for the investors?
Well, if you're talking about the industry, the worst case scenario was obviously the high profile frauds that occurred a couple of years ago now, whose names I won't mention. But in a worst case scenario, the borrower, there's more potential for the borrower probably to go to default and go bankrupt. You could lose your whole investment. But on the plus side, with debt, you will usually be diversified across several different loans. So I have less of an impact on your investment. I think also, this isn't really worst case scenario, this is kind of best case scenario. You actually can spread your investment a lot easier. There's a lot more grounds to test it, I think. And there's a lot more liquidity because you will often, you obviously need to find other investors in the market to take the place if you do want to opt out early. But I think there's probably more potential on the P2P side. But the worst case scenario, you're going to lose your investment. You've got no transparency. There's no grounds to appeal or do anything like that. You're totally bound by the platform's regulatory approach and compliance approach, and you're entirely trusting that they've done the mitigation and put the mitigation in place via a credit committee or whatever other means they do. So yeah, you may not see the performance of the loans. You may lose everything.
I do want to highlight that we are talking about FCA authorized platforms. We're not talking about some platforms that claim to be doing crowdfunding in the way that we're talking now, and yet they don't have an FCA registration. They aren't approved to do crowdfunding. They may be legally and successfully in business, but they're not a crowdfunding platform the way we're discussing today.
Yeah, no, that's a good point. Yeah, worst case scenario, obviously on the equity is certainly capital is always at risk. You know, there's absolutely no returns guaranteed, but I do feel there's a degree of comfort in that there's a shareholding of an SPV that owns an asset, and while it may take much longer for the asset to be realized and for the initial shares to be bought back, if a developer halfway through can't finish it, in fact the project, at least the shareholding has a degree of value, and that I think is a little bit different than just having your money lost completely, where a loan defaults, developer goes bust, or a platform goes bust. But really what it comes down to in summary, and to wrap up, is it's risk versus reward. People ask me, I've done 2 podcasts this week, and one of the big questions is why equity rather than debt? And for me, it's easy. John made the point that it's much harder to get equity than debt, and therefore the biggest problem for fundraisers, the biggest pain point, is equity. So therefore, why not have a business that tries to address the biggest problem in the market? But also the reward versus risk balance. I think that a lot of investors aren't that excited and interested in sort of a less than 10% return on their money. As part of a diverse portfolio, they may have some money there, but they also want to have the opportunity to earn a bit more. And I think that's where equity comes in. So sort of finally then, Tony, like a summary of the advantage of peer-to-peer on your side. If you were talking to an investor, obviously we're just playing scenarios here, you're not giving advice, but how would you pitch peer-to-peer to an investor?
Well, on the peer-to-peer side, you can have as much transparency or as little transparency as you want. So you can get involved probably on a lesser scale than it's less demanding than equity, because on the peer-to-peer side, you can just leave the loans to perform as they should do. So you don't need to get involved in shareholder agreements or anything like that. But obviously, because of that, you've got to expect that you don't have the same level of control. But with peer-to-peer, although the reward is significantly less than equity, you have got the chance to diversify to a greater extent.
Okay.
So
that's a good.
It takes a hit on your investment. It probably won't affect it as much as investing in a single project that fails.
Okay. No, that's fine. I don't know if John's prepared to put his head above the parapet and declare a winner, or we'll just call it a draw.
I think people need to look at both, and they need to put it in the context of their own investment decisions and where they're trying to go with what they're doing. These are tools, these are solutions, but they're not for everybody. Yeah,
absolutely. Okay, then just to wrap up, there'll be a message going out to all the investors on Citygate House, because we actually took the decision to close Citygate yesterday. We're obviously above the minimum raise, and the developer wants to get a move on with obviously moving to the drawdown of funds, etc., and the shareholder agreement. So it's currently obviously closed. You'll see on the platform, and we'll be communicating to all the investors about that over the next day or two. We are continuing to do the DD and the preparation for the project in Witcham, and when we're ready to actually launch it, view deal, obviously we'll let you know. But really, just in conclusion, we've actually currently been onboarding 4 new projects actually. So there's just a wee bit of a sneak preview of some of the projects that we will be making on the platform very shortly. There's a planning game that's being prepared currently down in the Devon area. A very interesting project. One's got a lot of character. We've also got a couple 2 behind the curtain deals being prepared, and also an HMO conversion for resale being prepared. So tune in for that. We'll be able to inform you as soon as we can. Obviously, we're through the DD at the minute, waiting for approval on the projects. So obviously, we can't disclose details until that approval is finished. But just to let you know, there's some exciting projects on the way. And with that, obviously, people know you can reach out to John and myself if you do want to have a conversation with us about consultancy. I know there were some inquiries, I think, after the event on Friday. Obviously, when they heard John sort of spend a good time on stage talking about structuring deals, and a lot of fundraisers realize that there's maybe more learning to do in preparation for crowdfunding. So by all means, reach out to John and myself on that if you so wish. So Tony, I'll give you the last sort of comment you want to make, either about crowdfunding in general or anything you want to comment on, or as a means of a goodbye.
Yeah, actually, someone's put something in the chat there, which is a really valid question regarding the collapse of a competitor platform, I guess you could say. I won't say the name, but the name's there. But my view on that is that it was actually really positive for the industry, because although the FCA really clamped down in a regulatory sense, they're actually now beginning to get a bit more structure and organization in place. And the regulations are only for the investors' benefit. So it's only worked out well for the industry that there's good practices in place now. And the people that do the bare minimum or barely met compliance levels, they're losing their licenses now. So you've got a stronger caliber of crowdfunding platforms now.
Yeah, John, any comment you want to make on the question in the chat box?
No, I mean, there's more than one firm. That was the smaller one that failed.
Yeah.
There was a larger one, and all the big failures have been in the peer-to-peer space. So I'm not sure what that indicates, but clearly the FCA's clamped down and changed some of their regulations to correct for some of these problems. We're talking hundreds of millions were lost with thousands of investors. So the peer-to-peer hope was sort of flawed originally.
Yeah. Interesting. So it's a relatively new market, still maturing, and we look forward to being part of the journey of this exciting industry. So Tony, thank you for coming. Hope that's been useful to the attendees to see a little bit of a debate about peer-to-peer versus the equity side, and I think that's been very useful. Obviously, you'll be able to go back and watch the recording on our YouTube channel. If you haven't already, make sure you click subscribe on that. Listen, thanks everyone for joining. I look forward to seeing you next Thursday at 10 a.m. for our weekly broadcast.